If you look at the Mag 6, as you were referencing, Mag 7 ex Tesla, if you like, that's the one group in the stock market that has actually seen their earnings growth year to date exceed their price growth. In other words, they're one of the few groups to actually have PE contraction amidst this rally, right? If you put a gun to my head and say I can only own one chunk of the market for the next 2 to 3 years, it's that group of stocks, clearly, because I think they've just got tremendous fundamentals. There's obviously a lot of caveats to go with their whole AI build out and whether that's going to generate the returns that the street expects it to. There's another comment I'd make here, which is that earlier this spring, there was a real fear that fixed asset growth would be extremely vulnerable in the age of tariff uncertainty. And what I found astounding, I was wrong and I was shocked by this, but the numbers bear it out, that thus far, companies, not just the big six, but across the equity complex, have guided up capex over the next 12 to 24 month period, much high, above their 10-year mean, for example. In other words, the big six are up 25% year to date on their capex budgets. And that's continued through July and August.
Michael Purves with us at Tallbacken, and we welcome all of you across the nation. Good morning, 99.1 FM in Washington, 92.9 FM in Boston, and Bloomberg 1130 in New York, the way you listen on radio across the nation, including Sirius XM, channel 121. David?
You know, we have Steven Mnuchin, who's going to have his confirmation vote, I gather, tomorrow. I think that's when the Senate Banking Committee scheduled that vote. And you had a great note out just about the president's push here to erode Fed independence and what that actually means for the bond market and for longer-term debt especially. Could you just tease out a little bit of sort of the kind of counterintuitive way that's likely to play out? The president might want one thing, but by doing this, jawboning in the way in which he is and agitating for the removal of some members of the Fed, it could kind of backfire for him and for his colleagues at the White House.
Right. I mean, if you look at the very sticky term premium through August, I think that sort of nicely maps out with Trump's push on Cook at the Fed, right? And I think this concept of the Fed not being independent, in a way it never has been, is something that's going to sort of an enduring risk premium that has to be sort of priced by the back end of the bond market. And I think you've been seeing that, right? So I think the question is, so almost the more Trump pushes for what he wants for, he's creating his own headwind.
Right. Have you ever seen, we give you grief, but I mean, he was under the buttonwood tree. Have you ever seen the separation of retail from institutional in belief like we have now?
I mean, it gets a little bit blurry. I mean, I guess you could reference back to 1999. There was something where a lot of quote unquote smart institutions.
The distinction from 99, my recollection is, we didn't know if they were profitable, and we learned in 2001 they weren't.
Yeah, there were stories.
Now they're minting the money, right?
Certainly the big six are. I think the question that you have to attach to that is whether they, whether this AI buildup, this capex expansion is something that is unprecedented for those companies. I mean, maybe Amazon's a bit different, but certainly for the Microsofts and the Metas and all that kind of stuff, it is just massive. Collectively, they're going to spend $800 billion over the next 24 months, just those six companies.
Can I come back to that? We're going to have Nancy Tengler on a little later in the show, and she pointed out something, one of her most recent notes, that those hyperscaler capex spend is now greater than 30% of SPX total capex. So we talk about concentration in the market broadly. Is that inherently problematic, that they're carrying so much weight in terms of that kind of expenditure?
Look, I don't know if it's problematic. It is sort of what it is. They carry huge weight in the index, and they carry huge weight in the fixed asset growth story here. That does spill out into a lot of other companies too. Right, but I think the question is as we get past this, right, then what, right? I think there's a big question as to what that means economically, not just for those companies and for the broader economy, but are we in a very different sort of economy at that point? I don't think anyone knows the answers to this question. So there are risks associated with it, but I do think that these capex budgets, they're very resilient to policy, to whatever policy we get out of the White House, whatever future tax deals we get, whatever regulatory, they're just going to do that, right? I mean, I think those things are locked. more traditional, older economy, economically sensitive companies, their capex budgets, which generally are higher, except for consumer staples, measured since last December, those are going to be more vulnerable to any sort of economic contraction.